Hey guys, Pete here. Welcome to my investment portfolio update for September 2022. This is the fifth video in this series where I give you guys a peek behind my own investment portfolio, strategies and performance so that you can not only see a real life example of how someone could go about managing their own investment portfolio, but also so that you can learn both from my successes and my failures. This YouTube channel is all about complete transparency, and therefore I will continue to share my portfolio performance even though the markets are down and we are only seeing a sea of red everywhere, because I truly believe that there are some crucial lessons to be learned during market crashes and bear markets that will either make or break us as long-term investors. Alrighty, so let's jump right into it. Now, in order to put our investment portfolio performances into perspective, we need to look at how the overall market has performed the past couple of months. I like to use the S&P 500 index tracker, which tracks the performance of the top 500 companies in the US, as it is one of the oldest and most used trackers in the world. As you can see, the S&P 500 index has been down by 9.6% only in the month of September and 25.3% since the beginning of the year. This means that we fell right into bear market territory, which happens when an index falls by more than 20% since its all-time high. Now, I need to remind you guys that this index tracks the performance of giant companies like Google, Apple, Tesla, Meta and Amazon, who are all well established and extremely innovative and profitable. Now, the reason why these companies lost so much value is not because they suddenly became crap. It's because of everything that is currently happening in the world that are influencing investors' sentiment. During the COVID pandemic, the world closed down and people lost their jobs. Governments all around the world, especially inside the US, started printing more money to give to its citizens to encourage spending in order to prevent an economic collapse. This continued for the most part of 2020 and 2021, and seeing that the world has returned back to normal for the most part, we now sit in a situation where there is too much money circulating in the economy. This means that there's more demand than supply, and if we go back to third grade economics, this means that stuff will become more expensive. And if stuff becomes more expensive, inflation, which tracks the price difference between different periods, will also go up. And if inflation spirals out of control, we might hit a phenomenon called hyperinflation, where the value of the country's currency weakens at a rapid rate, kind of similar to what happened to the Zim dollar in 2007. Now, in order to try and prevent this from happening, governments and banks need to increase interest rates in order to make taking out debt more expensive. Because if it becomes more expensive to borrow, people are less likely to make impulsive purchases. And back to grade 3 economics, if the demand slows down, the prices of stuff will also come down, and in turn, inflation will also come down. Now, the problem with this scenario, which we are currently sitting at, is that because the interest rates go up, our debt also becomes much more expensive. This causes many people who took out home or car loans when the interest rates were lacquer low in 2020 to start prioritizing their savings towards paying off their debt instead of investing it into the stock market. And seeing that safer, conservative asset classes like cash and bonds now seem to offer much more attractive rates, people are pulling out their money from the stock market to store in these safe assets during these unprecedented times. And when there is less money in the overall stock market, the overall value of stocks will drop. And if the value drops, people panic and pull out more of their money, thereby kind of adding fuel to the fire, and this is how a market crash occurs. And then lastly, the value of growth stocks like Tesla, Apple, and Amazon are determined on their expected future earnings. When interest rates are low, it is rather cheap for these companies to borrow money to help fund their growth, and this will push up their current share price. But when interest rates rise, borrowing becomes much more expensive, thereby slowing down the growth of these companies, which means that the projected future value of these companies will drop, thereby causing their share prices to drop as well. So to summarize, even though there's currently blood in the markets almost everywhere, it is mostly caused by macroeconomic factors all around the world and not necessarily because these companies became poor investments. The market had many corrections in the past, just like this one, and it will continue to have many corrections in the future. And even though I understand that it is not lacquer to see your investment portfolio bleeding, especially if you only recently started with your investment journey, I actually think that now is a great time to be an investor. Not only does this bear market present an opportunity to buy profitable and well-established companies at a massive discount, but it also helps to solidify the principles of long-term investing in those who keep on investing into the companies they believe, regardless of the short-term volatility of their share prices. Investing is as much an emotional, mental, and psychological game as it is a numbers, statistical, and strategic game. So if you've done your homework properly and you have established a strong investment strategy based on your individual investment time horizon and your individual risk tolerance, then you should not be bothered by all the noise and should just continue to rand or dollar cost average your money into the market as you've always done. And if this market correction exposed a couple of holes inside your investment strategy, then now is also a great time to revise your investment strategy, to rebuild it from scratch so that you can be better off in the future. Okay, so now that I am done with my speech, let's see what I did with my investments this month. During the month of September, I invested a total of 24,500 Rand, split between 1,000 Rand into my individual local shares portfolio, 2,500 Rand into my passively managed tax-free savings account, 500 Rand into my passively managed retirement annuity, 500 Rand into my passively managed properties account, 2,000 Rand into my offshore shares portfolio, 15,000 Rand into my passively managed offshore ETF portfolio, 2,000 Rand into crypto, 500 Rand into my actively managed tax-free savings account, and 500 Rand into my actively managed retirement annuity. This is a lot more money than what I usually invest, but as I've said, the drop in the market presents an excellent opportunity to buy great companies at a massive discount, and therefore I bounced on the opportunity with everything I had. Right, so let's start with my local individual shares portfolio, which I have with EasyEquities. By the end of September, my portfolio value was 10,680 Rand with a loss of 1.3% or 131 Rand. I owned 15 individual shares, including African Rainbow Capital, British American Tobacco, Capitec, Richmond, Discovery, MTN, Naspers, Process, Purple Group, Sasol, Shoprite, Sibanye Stillwater, Standard Bank, Spar, and Transaction Capital. My best performing local stock was Naspers with a profit of 27.9%, and my worst performing stock was Capitec with a loss of 21%. I added 1,000 Rand to this portfolio and bought Aspen and Northern Platinum shares, both for 200 Rand, and then invested another 200 Rand into British American Tobacco, MTN, and Spar. Now, I explained the entire strategy behind my individual local shares portfolio in my investment portfolio update video of August, if you guys want to go and check that out. And after moving things around a bit, I only needed to add Aspen and Northern Platinum in order to own all the shares that I want at the moment. Now, in order for me to decide which companies to invest in every single month, I basically look at those who are the most undervalued and then buy more shares in these companies. I use the Simply Wall Street platform analysis tool for this, and as you can see, Aspen is currently trading at 66.8% below its estimated fair value, Northern Platinum at 53.1%, British American Tobacco at 73.3%, MTN at 66.9%, and SPAR at 57.4%. Now, I'm still a relative beginner in the individual stock picking game, but every month I do try to earn a little bit more, and then I share what I've learned during this portfolio update series. So if you would like to learn alongside me, then make sure that you are subscribed so that you don't miss out. Then with my offshore individual shares portfolio, which I also have with EasyEquities, I added 2,000 Rand, which equated to about $109 at a rate of 18 Rand and 33 cents to $1. This is not a great exchange rate at all, but even though the Rand weakened against the dollar at a rapid rate, I continue to follow the exact same strategy of transferring 2,000 Rand regardless of what the exchange rate is, as I believe that the opportunity to buy companies at discount far outweighs the small loss in currency conversions. At the end of September, my US individual share portfolio was valued at $3,229 with a loss of 8.5% or $289. I owned 9 individual stocks, including Google, Amazon, Apple, Berkshire Hathaway, Meta, Microsoft, Nvidia, Tesla, and Twitter, as well as 2 ETFs, including Vanguard S&P 500 and Vanguard FTSE Emerging Market ETF. To date, my best performing stock is Twitter at a profit of 21.4%, and my worst performing stock is Nvidia at a loss of 18.1%. This month, I invested $50 into Meta and $30 into both Amazon and Google. I followed the exact same approach as my local individual shares portfolio by looking at the analysis of the Simply Wall Street platform, where Amazon traded at a discount of 64.1%, Google at 60.1%, and Meta at a whopping 84.5%. Then with my passively managed tax-free savings account, which I also have with EasyEquities, I added 2,500 Rand, which brought my portfolio balance to 36,945 Rand with a loss of 4.4% or 1,598 Rand. My tax-free savings account portfolio strategy is to basically split up my allocation between 40% local shares, 40% offshore shares, 10% local property, and 10% offshore property. And if you want to know exactly how I got to this allocation, then go and watch this video. Now, I use the Core Shares Total World ETF for my offshore shares, the Satrix Top 40 ETF for my local shares, the Signia Global Property ETF for my offshore property, and the Satrix Property ETF for my local property allocation. By the end of September, my allocation was 35.3% local shares, 36.2% offshore shares, 17% local property, and 11.5% offshore property. So in order to try and align it more with my desired split of 40-40-10-10, I invested 1,000 Rand both into the Core Shares Total World and the Satrix Top 40 ETFs, and 500 Rand into the Signia Global Property ETF, which brought my allocation to 35.6% local shares, 36.6% offshore shares, 15.8% local property, and 12% offshore property. Then with my passively managed properties account, which I have with Easy Properties, I added 500 Rand, which brought my portfolio value to 2,518 Rand with a profit of 2.2% or a whopping 32 Rand. I owned 3 properties, Black Brick, Capital on Bath, and the REIT, and I'm still waiting for the sale of the Fynbos to go through. I invested the 500 Rand I deposited as well as the 40 Rand that I received from rental income into the Duke, which has an estimated internal rate of return of 11.2% per year. Then moving on to my passively managed retirement annuity, which I have invested in the Signia Skeleton Balanced 70 Fund. I invested 500 Rand, which brought my portfolio value to 26,637 Rand, which is still at a loss of 1.9% or 506 Rand. Now, I am planning on investing a lump sum into this investment soon in order to try and capitalize on the discount that the companies which my RA is invested in currently trades at. The 1-year performance of this RA is currently at a loss of 8.5%, but that is okay because the 1-year performance of the S&P 500 is currently at a loss of 16.5%. So when compared to the performance of the US market, which is currently the strongest economy in the world, my little RA is not doing too bad, even though it is still at a loss. Remember, you need to look at your portfolio performance relative to the overall market and not just blindly stare at the rand value or percentage change in order to know if you have a good investment strategy or not. Alright, so the biggest investment that I made this month was where I converted 15,000 Rand into US dollars, transferred it to my Interactive Brokers account and bought 8 shares of the VWRA ETF, which is an Irish domiciled ETF which tracks the whole world's economy. I also sold my 1 share in the EIMI ETF, which is another Irish domiciled ETF which tracks the world's emerging markets. This was all part of a comprehensive tutorial that I am busy making on how exactly to use the Interactive Brokers platform as a South African, and once I'm done creating the video, I will link to it here in the info card and down in the description for those who want to know exactly how to fund the Interactive Brokers account, how to buy and sell shares using the Interactive Brokers platform, and how to eventually withdraw funds back into their local bank account again. Anyway, my offshore ETF portfolio currently sits at $2,271 with a loss of 20.9% or $390, which is still in line with the performance of the overall market over the same period. I'm now only invested in one ETF, the VWRA, of which I currently own 24 shares. Now, if you want to know why I use the Interactive Brokers platform for my offshore ETFs instead of the EasyEquities US dollar account, then go and watch this video where I explain exactly my reasons. And then lastly, moving on to my crypto portfolio, I invested a total of 2,000 Rand, which was split equally in 4 different ways. First, I utilized the auto buy function on the easycrypto.com platform to buy 500 Rand of both Bitcoin and Ethereum, which were automatically transferred to my Exodus wallet. Now I really came to know and love what this platform can provide, and I will also be releasing a video next week where I will show you guys exactly how I use the easycrypto.com platform to follow one of the best investment strategies when it comes to building a diversified crypto portfolio, so make sure to stay tuned for that as well. Next, I transferred and invested 500 Rand into the EC10 bundle from easycrypto.co.za, which brought that portfolio to a value of 6,545 Rand with a profit of 9.9% or 544 Rand. I also transferred and bought 500 Rand worth of the top 10 bundle from Revex, bringing that portfolio to a value of 10,836 Rand with a loss of 21% or 2,886 Rand, which is split almost equally between Bitcoin and the top 10 bundle. I then also have 2,519 Rand invested in Bitcoin and Ethereum with Luno, which currently sits at a loss of 45% or 3,741 Rand. Now, I will probably transfer my Bitcoin and Ethereum from Luno and my Bitcoin from Revex to my Exodus wallet in order to safely store them together, and moving forward, I will try to continue to invest at least 2,000 Rand per month into these 4 holdings, because even though the crypto market took a massive knock the past couple of months, I still believe in the value that blockchain technology will eventually bring in the future, and I am therefore smiling all the way when I can buy these great coins at massive discounts. So this brings my total passive investment portfolio at the end of September to a value of 193,938 Rand or 11,083 US dollars, split up between 19.2% individual shares, 68.7% passive ETFs and unit trusts, 1.3% property, and 10.8% in crypto. My ideal portfolio allocation would be to have at least 70% invested in broad market ETFs and unit trust, and then split up the other 30% between individual shares, property and crypto. So I may need to invest another lump sum into my RA soon in order to help align my portfolio more towards my desired allocation. So yeah, even though the markets are currently looking bleak, I gooyed all my savings into the market this month and will continue to do so whenever I can, because I know for a fact that the markets will eventually recover and that future Peter will look back and be glad that I did. Thanks for watching, guys. Let me know down in the comments if you have any questions. You must all have a lekker day. Cheers.